You know, there is a massive wealth transfer happening right now, literally in your own neighborhood. While everyone else is glued to their screens, getting distracted by flashy tech stocks and the latest crypto craze, there is a silent, multi-billion-dollar corporate takeover happening right beneath our noses. Welcome to Zak Invest. I'm Zak, and today we're walking through a masterclass explainer on what I call the boring monopoly. We're going to expose the exact strategy that elite investors are using to swallow up the physical, tangible, everyday services that keep this country running. And more importantly, I'll show you how you can use this exact framework to build your own wealth.
Think about it for a second. Picture your trusted local veterinary clinic, your neighborhood pharmacy, or maybe your family dentist. The faces at the front desk look exactly the same as they always have, right? The doctor's name is still proudly displayed right there on the door. But here is the illusion. In a lot of cases, that business is no longer actually owned by the practitioner you're talking to. It is highly likely owned by an invisible Wall Street empire.
Okay, let's dive into this. The mainstream media loves to feed us this very specific story, right? That mom and pop shops are completely dying out, just getting crushed by massive online retailers. But honestly, that is a myth. Small businesses aren't dying. They are actively being swallowed up by smart money. Private equity firms are completely ignoring those flashy tech companies. Instead, they are quietly buying up unsexy, essential, everyday services by the thousands. We are talking dental offices, property management firms, specialty pharmacies. By consolidating these behind the scenes, they're building massive, legally protected, and just incredibly lucrative regional monopolies. They aren't trying to be the next Apple. They literally just want to own every root canal and leaky faucet in your zip code.
Look, private equity isn't buying up vet clinics because they suddenly developed a deep love for animals. Not at all. They target what I call the holy trinity of business metrics: high profit margins, massive market fragmentation, and incredibly sticky recurring revenue. Think about it. When your dog gets sick, you aren't hunting for a discount code online. You go to the doctor you trust and you hand over your credit card without blinking. That revenue is bulletproof. It's highly predictable, and those customers are fiercely loyal.
And this brings us to the sheer scale of the opportunity. We are talking about tens of thousands of these individual clinics across the United States. Right now, a huge portion of them are owned by aging baby boomers. These owners are sitting on highly profitable cash-flowing machines. But, they're tired. They're ready to retire, and often they have zero succession plan because their kids simply don't want to take over the family practice. For an amateur investor, a single vet clinic just looks like a small local job. It's nice living, but that's it. But a private equity firm, they see it as a single brick. If they buy 50 or 100 or 500 of these clinics, they aren't running a small business anymore. They are building an impenetrable brick wall. By applying corporate scale, centralizing back-office operations, and negotiating massive bulk discounts for medical supplies, they instantly increase the profit margins of every single clinic they acquire. It's brilliant.
Now, multiple arbitrage sounds like a bunch of complicated Wall Street jargon designed to confuse you, but the secret is actually brilliantly simple. It is the strategy of buying individual businesses at a low multiple of their cash flow, bundling them all together into a massive entity, and then selling the whole package at a massive premium. Value isn't just created by adding revenues together. The real magic happens because they fundamentally change the multiplier applied to that revenue.
Let's contrast this so you can really see it. When a solo veterinarian sells their clinic, they might get, say, 3 or 4 times their annual cash flow. Why? Because the open market views it as risky. It relies entirely on one single doctor in one single town. But when a private equity firm buys 10, 20, or 100 of those clinics, they create a massive, diversified network. When they sell that network to a larger institution or even take it public, it is viewed as a highly scalable platform. And guess what? Massive platforms sell for 15 or 20 times their cash flow.
Just look at that massive explosion in value. Jumping from a 3x multiplier to a 20x multiplier happens because the market willingly pays a massive premium for corporate scale. This is the exact math that turns ordinary, everyday investments into true generational wealth almost instantly. It all comes back to this one reality. The value exploded because they changed the multiple applied to the cash flow. They literally create billions of dollars in equity out of thin air entirely by restructuring the ownership of boring local businesses. That is the core, undeniable, mathematical reality of this entire strategy. A leveraged buyout, or an LBO, is the absolute ultimate use of other people's money. It's the acquisition of a company using borrowed money, where the target's own assets and cash flow are used to pay off the debt. Think about how wild that is. The target business literally buys itself. Here is the simple, step-by-step recipe they use. First, the firm creates a brand new legal entity. Second, they put down just a tiny fraction of the purchase price using their own cash.
Third, they borrow the rest of the money from a bank. And fourth, and this is where the magic happens, they put the debt directly onto the target clinic. The clinic's own cash flow pays the interest. So the private equity firm uses a tiny amount of cash to control a truly massive asset.
Once they roll up dozens of these clinics, the sheer scale insulates them from risk. Let's say one clinic in one town has a bad year, while the other 99 clinics easily cover the debt. Because the combined cash flow is so massive, they can refinance at lower rates and then pull their original equity back out, completely tax-free. They've built an empire that is entirely insulated by scale.
Now you might be thinking, Zach, I don't have $1 billion lying around to buy 100 vet clinics. And you don't need to. You just need the right blueprint. Here are 3 distinct, highly actionable ways you can apply this exact masterclass to your own financial journey starting today. Let's break them down. Strategy 1, invest in public consolidators. A lot of these massive private equity roll-ups eventually go public on the stock market so they can cash out. By simply buying shares of these holding companies, you are effectively becoming the landlord of hundreds of local businesses. You get to collect dividends, you benefit from the stock going up, and you ride the entire consolidation wave without ever having to negotiate a single business purchase yourself. It is the easiest way to play the game. Strategy 2, build a micro-monopoly. If you are an entrepreneur at heart, stop trying to start brand new businesses in crowded, hyper-competitive markets. Seriously. Look for boring, unsexy, highly fragmented industries like landscaping or local property management. Buy 3 local competitors who have outdated tech and are still running things with pen and paper. Centralize their software, their dispatching, their back office. By creating a dominant regional brand, you are executing the exact same Wall Street strategy, just on a micro scale. Strategy 3, own pricing power assets. Look, here is the harsh inflationary reality of this trend. Consolidation almost always leads to higher prices. When a local monopoly controls the vet care or the prescriptions in your town, they get to dictate the cost. Prices in these industries rise way faster than general inflation. So as an investor, your takeaway is crystal clear. You have to position your portfolio to own the assets doing the consolidating. Because if you are just the consumer, you are the one footing the bill for those higher prices. Guys, this isn't just a passing phase. It is a fundamental restructuring of the American economy. The era of the independent mom-and-pop shop is shifting rapidly to the institutional, scaled platform. The most profitable game in town isn't that flashy new tech app. It is found right there in the unsexy, boring industries, supercharged by the financial engineering of multiple arbitrage and leverage.
So I want to leave you with this question to really think about. When you walk into your local pharmacy or vet clinic tomorrow, take a look around. Are you going to remain just a consumer paying the bill, or are you going to use this framework to start building your own monopoly? Stop ignoring the unsexy industries, because that is where the real generational money is being made. I'm Zach, and if you want to keep mastering the invisible economy and building financial freedom, make sure to subscribe to Zak Invest for more frameworks just like this one. I'll see you in the next explainer.